Market volatility. Volatility is the measurement of how much an asset changes in value over a given period of time. If a trader buys an asset, they expect that asset to increase in value during the course of that trade. Conversely, if a trader sells an asset, they expect it to decrease in value during the course of the trade. The more its value changes, the higher its volatility. If the price of an asset has a high volatility, there is more risk associated with trading it, but greater potential for profits. If an asset has a low volatility, there is a lower risk trading it, but less profit potential. Market volatility can also be referred to as price volatility, or trading volatility. As a trader, you are always looking for ways to increase profit. Thus, you will seek out the most volatile assets which give higher potential for profit. Measuring market volatility. In trading, volatility is measured using certain indicators including moving averages, Bollinger Bands and average true range, ATR. Each of these indicators can be used slightly differently to measure the volatility of an asset and, more importantly, interpret this data in a different format. Moving averages. Moving averages are displayed on the actual price chart, and the distance between the moving average and the price shows the volatility of the asset. The further away the price is from the moving average, the higher the volatility of the asset. The figure shows the average line moving far above the price above it, indicating that this asset has high volatility. The next image demonstrates an asset of low volatility. The moving average is close to the current price. Bollinger Bands. Another very common tool used to measure price volatility is the Bollinger Bands indicator. Bollinger Bands display the volatility in a slightly different way. Several lines are applied to the price action which squeeze together when volatility is low and expand when it increases. An asset with expanded bands is in a high volatility state. The image below demonstrates what Bollinger Bands look like on a price chart when volatility is high. This figure shows what the bands look like when a pair has low volatility. Average true range, ATR. Another common measurement of market volatility is the ATR indicator. This tool measures the volatility and gives an actual value. So rather than observing the price in relation to a tool, such as a moving average or Bollinger Bands, the ATR gives a value. The higher the value, the higher the volatility. The ATR also shows whether the volatility is increasing or decreasing, as well as what the volatility is at a given time. This figure not only shows that the asset has a high range, but that the range is increasing over time, indicating increasing volatility. High range. 1 range increasing over time. Low range. 2 range decreasing over time. How to use volatility. If the volatility is low and decreasing, it is much safer to avoid placing any trades on that pair as the probability of a profitable move occurring is greatly reduced. In contrast to this, when anticipating large moves, particularly breakouts, it is important to trade in times when volatility is increasing. When volatility is high, the probability of a large move occurring is higher and traders have a greater chance of making money.